Hello, and welcome to session 7 of Moms on the Money Trail. My name is Katrina Boyer. I'm the Investor Ed Coordinator at the Pennsylvania Department of Banking and Securities. And joining me today is Karen Carr, an outreach specialist and consumer programs from the Pennsylvania Department of Treasury. And today we're talking about different types of investment accounts, everything from retirement to wealth building accounts, and even information about educational accounts for your children and some other programs that Pennsylvania Treasury offers. So we're going to jump right in and we're going to talk about personal individual retirement accounts or IRAs. An IRA is an account that you open up and you deposit money from your pay, or you have that money deposited. Um, every time you get paid or monthly, the amount that you can deposit into your IRA is $7,000 a year for 24 and 25. If you're over 50, you can add an extra $1,000 to that for a catch-up account. What's great about IRAs is that the money goes into the account before you pay tax on it, and your earnings are going to grow tax deferred until you make those withdrawals. When you start to withdraw money from those accounts, at that point, you'll be paying tax on that money. What's great about IRAs is that you can choose the type of investments that you want your money to go into, as long as that is an option that's offered by that firm that's handling your IRA. Now, that's a traditional IRA. A Roth IRA is different in that you're making your deposits to that account after you've already paid tax on it. So you have the same maximum deposits of $7,000 a year, but when it's time for you to withdraw that money is actually tax-free because you've already paid tax on it when you initially opened the account. So those withdrawals and any earnings that you may see are going to be tax-free. And if you have an emergency or there's a need for you to withdraw money, you can withdraw your contributions, that money that you put in yourself, without a penalty. So that's a really great thing to keep in mind, especially if you're looking to maybe use it to for home ownership or some things of that nature. We never encourage you to plan that, but it can help to plug some of those gaps if you need to do that. Now, we all kind of have heard these terms, I'm sure, IRA, traditional, and Roth. But what you may not realize is that there is a spousal IRA, which is really great for those married couples where you've got one spouse who's not working, because it allows that person that isn't working outside the home to be able to save for their retirement in their own name. And it is the same maximum amounts for contributions. So again, it's $7,000 if you are under 50. Once you hit 50, you can add an extra $1,000 to that contribution every single year. Now, I want to sort of transition into employer-sponsored retirements. And what we often think of is a 401k. A 401k is a retirement program that's offered to employees of a for-profit company. The earnings that you contribute or the money that is being earned in your 401k grows tax deferred. Um, what I think is really fantastic, and I think it's really important that we ask the question, is does your employer match a certain percentage of your contribution? That's a really important question to ask because you may be missing out on what we like to consider as free money. The maximum contributions for 2025 are $23,500 a year, or 100% of your income, whichever might be less. Once you hit that 50-year threshold, you can actually bump that up by an extra $7,500 for catch up. One thing to keep in mind with a 401k is, again, your earnings are growing tax deferred. And when you start to withdraw that money to live on for your retirement, at that point, you're going to have to be aware that you'll be paying tax on that money. I think it's really important that we understand the tax ramification for all of the different types of accounts we're going to talk about. So similar to a 401k, state and local government employees often have access to a 457B, where it's the same contribution maximum. So it's that $23,000, $23,500. The thing to keep in mind for government employees is that those organizations very rarely match any of your contributions. But they do allow for that catch up once you turn 50. Now, there's a 403B, which is basically kind of the same as a 401k, but it's for employees of nonprofit organization and public schools. Again, the earnings grow tax deferred. Sometimes that organization, that nonprofit, or that school will offer some matching contributions, which is, again, really important for us to know when we start thinking about contributing to these opportunities. Now, I will tell you, and I think it's really important to stress, for these employer-based retirement options, you don't have to put a lot of money aside every pay period. It can be 1%. It can be $25. What is important is for you to start that habit. I know from personal experience, way back when I started contributing to my deferred comp, my 457, the reality was I set it for like $25 a pay period, and I saw that I didn't miss it. As time went on, I changed that to a percentage of my income. And so every time I get a pay raise, I actually then am contributing more to my deferred comp, and I'm not seeing a big, I don't see it. So you don't miss what you don't see. I think that's something that is really important for us to understand. So we want to make sure, before we start talking about wealth building accounts, I want to make sure that I emphasize that if you're able to pay into your retirement fund through your employer, make sure again that you ask about their matching contributions, because if your employer will match 3% of your income, if you put in 3%, that's doubling your money. That's really important for us to take advantage of. You never want to pass up the opportunity to have free money. So keep that in mind. So now I want to talk about wealth building accounts. When we think about wealth building accounts, I think, we think about our retirement accounts, and those are really for our retirement. Once we turn 65, we plan to use that money. With a wealth building account, that's money that we're just going to put into our accounts. We're going to use it to invest. And the reality is that there aren't any maximums that we can put as far as our money goes. This is a great way, if you get a lump sum, to be able to start investing, to be able to plan for your financial future. If you have long-term goals, maybe again you want to start thinking about buying a home, putting your money into a wealth building account so that you can invest it and take advantage of those higher potential earnings, and you want to do that for the next 10 years, That's a great way to be able to do that. So wealth building accounts there are quite a few different types. There's a wide range that you can sign up with. There are robo advisors, there are online brokers. Um, it's important to know that there are fees that go with all of them, and that's important for us to understand before we decide what we're going to do with our hard-earned money. So I want to spend a little bit of time talking about each of the different types of taxable investment accounts or wealth building accounts that we have. So if your goal is to be able to buy and sell investments or different securities on your own, you may be interested in an online wealth building account where you would have an investment broker or a broker dealer who you would tell, take this money and buy me X amount of shares in this company. This is ideal for someone who wants to do their homework, do their research, and be able to buy and sell their own investments. Um, the fees are going to be transactional, so you're going to pay a fee anytime you tell your broker or your broker dealer that you want to buy or sell or move your securities around. That's important to understand. And in an upcoming session, we're actually going to talk more deeply about those fees and what you can expect and how to do your homework on the investments that you're considering. So the next type of wealth building account I want to talk about is what's called a robo advisor. Um, a robo advisor is basically a computer program that allows you to answer a few questions, and the computer program actually will decide sort of what is going to work for you. We like to think of it as hands-off investing. It's one of those things where we can set it and forget it. So you might decide to put $50 a month into your wealth building account. The robo advisor is going to put it where they think it might be best. Again, that's a computer generated thing. What's great about robo advisors is that their fees are relatively low. They're typically much lower than some of the other types of accounts that you could open. So if you are one of those persons that wants to just sort of know that you're doing it and let it do what it's going to do, this is a great option. The last type of brokerage or wealth building account I want to talk about are what we like to call managed accounts. They're sometimes called a full service broker account. And those individuals typically are going to get to know you on a deeper level. They're going to understand what your goals are as far as buying a home, as far as helping your children with their education, as far as where you want to live when you retire. They're going to understand that, and they're going to work with you to help you get to those goals. And they're probably going to be involved with more than just your investing goals. They may help you with insurance. They may help you with your taxes. They may help you with a lot of different information. So that's important to understand. But with that comes a different fee structure. Those fees are typically higher, and it may be based upon the value of the assets that they're managing for you. So again, we'll talk more about this in our upcoming sessions. But before you run out and open that brokerage account, it's really important that there's a few things that we do. So we want to make sure that we investigate and we make sure that the person that we're working with and the firm that they work for is licensed and registered to do business in the state of Pennsylvania. You want to make sure that you understand the investments that they offer, especially if you're doing some of that hands-on work. And there is a form that's called the Form CRS, or the Client Relationship Summary. The Form CRS is really helpful when it comes to deciding between one professional and another, because it outlines in plain English the fees that they're going to charge. It will tell you if there may be any conflicts of interest. It will tell you if they have a fiduciary duty or a best interest. Um, so it's important to review that summary and make sure that you're comfortable with the information that you are that you're getting into. And then I always tell people to ask questions of your professional. And we'll talk about some of those interview questions in our next session, where we'll go into more detail about what types of questions and how to hire that professional. So I mentioned that you want to investigate your professional. You can go to brokercheck.finra.org and you can type in the name of the person that you're considering working with, and you can see their full history. You can see which exams they've passed, what they can and can't do. You can see how long they've been in business. You can even see if they've had actions taken against them in Pennsylvania or another state. Or you can even see if they've had complaints filed against them in Pennsylvania or another state. I always tell people when you're looking at BrokerCheck to actually take a look at the complaints, if there are any. Because if if a client gets angry with their professional, they can file a complaint pretty easily. And it may be something simple like, my broker didn't get me the return on my investment that I wanted, so I decided I was going to file a complaint. It's important to understand the complaint before we decide to write off that investment professional. So let's talk a little bit about risk tolerance and diversification. The reality is we need to understand how much of a risk we're willing to take with our investments before we start putting our money into investment accounts, because each of those types of investments can involve different levels of risk. And so we want to make sure that we're comfortable with the risk that's associated with the investment. And we always want to keep in mind that we don't want to put all of our eggs in one basket. So we wouldn't want to put all of our investment money into one specific stock. You might remember that we talked a little bit about this in session 1 and 2, where we talked about investments and the different opportunities, the different types of investments that are available. So having your money in different types of investments and different securities in general is really important. It can go a long way in helping us be prepared for our financial futures. Before I turn it over to Karen in the next few slides, I do want to make sure that I emphasize again that you talk to a tax professional about what you need to be aware of when it comes to any of the different types of investment accounts that we've talked about. I think that's really important because we need to understand what impact this could have on our taxes right now and what impact it can have on our taxes when we're old enough to retire. Many of us are not even thinking about retiring, but if you start to invest in retirement accounts, it's important to understand those things. So again, make sure you talk with your professional. I always like to sort of end on a reminder that for our retirement accounts, those 401ks, those 403bs, the 457s, and the IRAs, keep in mind that you don't want to rely on your retirement accounts to fund an emergency. Understand what the options are and keep in mind that they really should be a last resort. In a traditional 401k, if you withdraw money before you're old enough to retire, you could pay not only taxes, but you could also have to pay a penalty. So you want to make sure that you understand what those fees and penalties might be in the event you decide that you have no other option but to use those accounts for emergencies. I always like to end on different resources that are available. So again, you've all seen our website, dobs.pa.gov. There is also a great consumer webpage that's sponsored, that's under the Securities and Exchange Commission at www.investor.gov. And then the IRS has a really cool kind of Q&A page at irs.gov/retirement plans. Those maximum contributions that I talked about change every year. The information that I gave you is good for 24 and 25, but going forward, if you're looking at trying to make the best, invest the most that you can, understanding what that is very important. And so with that, I want to turn it over to my sweet friend, Karen Carr from the Pennsylvania Department of Treasury. Karen, take it away.
Thank you so very much, Katrina. What you just gave us is like gold. That is something that I wish I'd listened to at a much younger age. I am now at that point of my life where I am looking at the retirement piece of life and understanding your finances and investments and putting money towards yourself and your future is so, so very important. And understanding how that works just will reap benefits in so many ways down the road. So thank you. And thank you for inviting me today. I am Karen Carr. I am the outreach specialist here at the Pennsylvania State Treasury. A lot of times at the Treasury, I will hear, how do I pay my taxes? Or how do I do this or that or the other thing that involves giving money back? No, we are here as the Department of Consumer Programs, and we are here to help you save and learn and invest and get your money back and get your money working for you. So thank you so much for this opportunity. On my next slide, we're going to talk about all of our consumer programs. But on my next slide, we're going to start with an investment that we are making in every child born to a Pennsylvania resident. It's $100, and it goes into an account that we manage at the Treasury for post-high school training and education expenses. So after they reach the age of 18, they could start to use this money that's been invested for future educational expenses. It's going to grow alongside your child, and it's going to be used once your child turns 18, as I said. What does this do, right? We are trying to provide some hope here for the future. That's why we started this. We want you to know that research has shown us when we did the homework on this, that any child with an educational savings account in their name, even if it's a modest amount, any little bit, right? They're 3 times more likely to go to college and 4 times more likely to graduate. Pretty good rate of return there when you're thinking about your children and their future and their goals and your expectations. This $100 was intended to help parents start to think about saving early. Think about it now, right? Think about it while your children are young, because then you start to get, when they're older and you start to panic, you're not going to have that base. But the Keystone Scholars is going to put that $100. You should be receiving something in the mail that looks like this. It's a 529 Keystone form. I hear parents sometimes say, oh, I think I saw something like that and I threw it away. Don't throw it away. It's money. Go there. Use that scan code, or remember that this exists, and you're going to register. First time user, you'll see that online with that information that you see here. You're just going to need the information from either this code that you get in the mail or from the birth certificate. You'll put that in. You'll have an email address. We'll keep in touch with you. You'll start a little account that you'll see there that you'll have a password and user ID, and you're going to be registered, and you can look at that on a regular basis to see how that's growing alongside your child. That's the Keystone Scholars. Now, you can't put money in this account, but you can put it in a PA 529 college and career savings program. What is the PA 529 College and Career Savings Program? Well, we have two of them here in Pennsylvania. We are so fortunate to have the Guaranteed Savings Plan and the Investment Plan. So there's two. They're designed to help you save for your children's future educational expenses. Now, every day you're not thinking about this, right? But it is a dream. You want your children to do their best. So you want to stop and think, can I put my money away a little bit? A little bit goes a long way, and save at today's tuition rates in the Guaranteed Savings Plan. So you could start to pay for Westchester University now. And then 10 years from now, you'll already have what you paid for today to use for tomorrow's rates, right? The investment plan is going to be more like that plan where you're going to make some of your own decisions, and it's going to be attached to the financial markets. So there's perhaps a little bit more element of risk, but also of reward. Then you're going to get those things that Katrina was just talking about, your significant federal and state tax advantages on your contributions, right? It's after-tax dollars, but your earnings on your withdrawals are tax-free when you use them in an educational account and you use them for educational purposes. And those purposes, you can use them for qualified technical collegiate apprenticeship, also K through 12 educational expenses, and paying back tuition. Here's all the different things. You get college, technical school, tuition, room and board you can use your savings to pay for, required books, supplies, and equipment. That's, your computers and computer-related expenses. You'll see that it doesn't just have to be for college. It can be for skills and career training. Student loan repayment up to $10,000 for each one. That is another great thing that they've added. And the K through 12 educational expenses. And that's at public, private, religious, elementary, or high school. So all of those things you can use these accounts for that you've been saving for on a regular basis. I want to point out this YouGift. Please do not forget that this exists. If you decide to open this account and start saving for your children, this YouGift account, and you can hit the next button. I think that'll show that what YouGift is, Katrina. You can give a really meaningful gift. So you'll open an account. There'll be a little gift box there that you can send a code to other people. Then they'll have their own little special account that they can start to give money to this account. I do it for friends and family, and I get to deduct what I contribute both to my 529, but also to other people's accounts off of my state taxes. That's one of my benefits that I get, keeping more money for myself and for education. It's free, and it allows other people to contribute for birthdays. What better gift, right? I mean, you can give toys, but that'll just last so long. This is something for their future. Thank you, Katrina. So I'm going to go in a little more depth about the Guaranteed Savings Plan. This is the one that grows with the way that tuition changes over time. We call that tuition inflation. This is designed not to expose you to the market fluctuations, but to the way that schools' credit rates change over time, right? That tuition goes up over time, or it changes. That's what we want to keep pace with. You're going to use this tuition inflation when you put your money in to buy things at today's cost and use them in the future, like a forever stamp. You buy a stamp today, guess what? No matter how many times that stamp changes prices in the future, you can still use that forever stamp. You bought it already. It's good to go. You choose how to save, and we have 5 options. We're here to help you figure that all out. You just pick up an option, and then if you need to change it along the way, you can do that at any time. We're here to help you do that. We're insulating people who use this from the economy and the financial markets and keeping pace with the way education changes over time, education costs. Thank you very much. Now I'm going to tell you about the investment plan. This one is a very nice plan because it's similar to some of those 401ks that we talked about, or Roth IRA, right? Some of those savings plans that Katrina just explained. But this is going to be an investment, obviously, for their education and not for their retirement. It's going to be based on stock market performance, and you're going to choose things that will have underlying funds or investments that are managed by Vanguard, very low fee. We have actually really one of the top 2 plans in the country. I mean, we're very highly rated by Morningstar. And if you like to maybe choose some of your own investments, you could certainly do that. We also have a target enrollment plan. Just want to tell you about that real quick. Could we just go back one more time to that last slide? I want to tell you about what we call the target enrollment plans. Katrina referred to kind of a set it and forget it type of thing that you could choose when you're looking at some investments. We have some within this investment plan that you can choose a target enrollment date that they might go off to school or when you might like to use it. And you can set and forget that plan and it will automatically change over time so that it becomes what we call more principal protected as you get to that date when you're going to use it. So it might be more aggressively funded in the beginning, but then over time it's going to get saved in a less risky investment for you so that you're not going to be worried about perhaps losing some of those funds that you've grown over time when they get ready to use it. So I just wanted to note that that's one of the things that you can choose from. So thank you, Katrina. The next slide, please. Remember, these are the important things, right? You can use the funds that you're saving and investing at any qualified educational institution if you want them to be qualified and keep those tax benefits and not have to pay taxes on your withdrawals back to the federal government. You can save for education, training, equipment, technology. You can easily have these come from your bank account. You just set it and it'll go right to the bank account on a regular basis or once in a while, however you want to set it up, or from a paycheck. And one thing you can do if your employer doesn't already offer this as an employee benefit, you could speak with them. It's free for them. It's a great thing for them to be able to offer the 529 plan as an employee benefit because then it's already set up for them. They know what they're doing. We can come and explain this to your other fellow employees as to how it works. But you can have it come right from your paycheck. They don't have to offer it as a benefit for you to have it come from your paycheck, but we encourage the employers to understand this. And then you can have family members use YouGift. Remember that every time when you're saving taxes on these things, that's more money in your pocket that you have to use for those educational financial needs that you may have or your children may have. Thank you. This is the most important part. Let me go back. That last little bullet point. Steadily and strategically save, starting now for your child's future success. Starting as soon as you can possibly get those few minutes and do that. Thank you. We're going to go to another program now. I want to mention that I have both the investment plan and the guaranteed savings plan. My children are grown. They've already used their plans, but I kept them open because this to me is a legacy account and they are able to then, I'm able to still fund it lightly now, not as heavily as I had for future grandchildren, which I don't have yet, but I know hopefully they're coming. If they don't come, I'll use the money myself. I'll go back to school or I'll save it for somebody else down the line, or they can keep it for ever and ever and ever. These plans go on forever, but I have both plans, an investment plan and a guaranteed savings plan, and I fund them for future. I want to talk now about PA-ABLE. How many of you can think of someone you know, or perhaps someone in your own family that has needs as a person with a disability? Someone with CP, right? I have a dear friend with cerebral palsy. There's people who have children with autism. There's people who maybe, were in a car accident and they have a disability where they're not able to maintain employment like most of the rest of us would, or, their needs down the road, they're going to need Social Security disability or that sorts of thing. This program is like a 529 in a way, but specifically for people with disabilities. It is a savings program. Next slide. This is created to allow these eligible individuals with a disability and their families and friends a tax-free way to save for their disability-related expenses while still allowing them to keep their government disability benefits. Those things include what I mentioned, SSI, SSDI, right? They might be getting some state benefits, SNAP or TANF. They can be able to protect all of those things in an account called PA Able. Their savings and their money goes into this account and it protects all of those important things. Able right now allows individuals to save up to $18,000 per year. Next year, it's going to be $19,000. And then if they're receiving SSI, Supplemental Security Insurance, they can have up to $100,000 or more without impacting those benefits. Right now, without an ABLE account, they can only have $2,000. And there are larger yearly savings for amounts of people who work with disabilities. These funds are very easy to access. PA ABLE accounts can be used for a wide variety and range of expenses. Common uses for PA ABLE accounts include almost anything you can think of. Housing, basic living expenses, assistive technology, even transportation, and they can roll a 529 account. They can take a 529 account if somebody's been saving for them and roll it tax-free into an ABLE account for education. They can use it for their health care. What is prevention, wellness, and more, right? It may be a trip somewhere. It's whatever that person has the needs for that is individualized to them. In order to have this ABLE account right now, as of this year, they will have had to have had a qualifying disability that began before their 26th birthday. The onset began before then. They can be 50 right now, but the onset of the disability would have had to have begun before age 26. Now, in 2026, that's going to expand to age 46. So you think of our veterans or somebody who had, a stroke at age 40, right? This will then be an account that they can have and be qualified to have. And they either need to be eligible for that supplemental security income, SSI, or Social Security disability insurance, or self-certify with a physician's note that they meet certain disability standards, that they can hold this account. And that really is the summary of that PA ABLE program. It is very valuable for so many individuals. I'm going to end with, do you have unclaimed property? We're going to ask that you look for both the organization that you work for other individuals in your family, your church, and see what unclaimed property might be out there. This is anything that might have been turned over to us in the form of a lost paper check, something that expires in a safe deposit box, an insurer for a life insurance policy. We see those all the time. Stocks, bonds, commissions, we see those a lot too, or dormant bank accounts. All kinds of things are returned to us in the form of funds, and we want to get those back to people. Is it your money? Do you know what? We are constantly replenishing the 4.5 billion that we have in our coffers here at the Treasury, and we want to get that back to the right people. It says 1 in 10 Pennsylvanians here, but I find it's more like 1 in 7 or 8 or 6 some days, just depends. And it could be as little as $5 to as much as thousands of dollars. I've found $70,000 for an individual. I've found $30,000. Come to patreasury.gov/unclaim and look. Put your last name, your first name in, put the name of your organization in, and just do a search. And we're here to help you. We have an 800 number, as you can see here, 800-222-2046. So that really wraps it up for me. I hope you find some money, and if you do, maybe you'll throw it into some investments. And we thank you so much for participating in this, and I wish you your very best in your savings journey.